The days that you think you cannot make it, the only thing that keeps you going is the desire to solve the problem. So I think all of that kind of culminated that by 2014, I had exited both companies and realized that in some ways being an entrepreneur and building from $0 to $1 million revenue was in some ways harder than running a $1 billion company. A perfect pitch looks different depending on the founder, which is we see dozens of pitches a day. Right? So why are you different? Why is what you're doing important? Why 5 years from now is what you're doing significant? Any M&A transaction could be considered a success because it means you've created something from nothing. Most really good things that happen in life tend to fall out of the sky.
Yeah.
Right. And I think just to be open enough and to be curious enough to explore the opportunities, I think is key and fundamental.
What is your biggest pet peeve right now? Welcome to Lucidity Insights podcast, The Perfect Pitch. I'm here with Noor Sweid, founder and managing partner of Global Ventures, a Dubai-based growth stage venture capital firm that you set up in 2018. And prior to setting up Global Ventures, Noor, you were the chief investment officer at Dubai Future Foundation and a GP at another venture capital firm. And if we go way back, you started your career as a strategy consultant.
Way back when, yeah.
Yeah. And so let's start there. I want to get to know you a little bit. How did you go from strategy consultant at Accenture all the way to the seat that you're sitting in now? I feel like there's been a lot of changing of seats and changing of roles.
Tell me a little bit about that. So my career started, way back when, as you kindly put it.
For all of us.
For all of us.
Thank goodness.
In Boston, out of college in 2001. And, I think at the time you either became an investment banker or you became a consultant.
Yeah.
There wasn't venture capital. Entrepreneurship was not a thing. So unless you were in an industry, those were really the two paths. You could go into investment management, asset management, but that was about it. So with those two options, and although I had studied finance, I didn't love working in finance. So I ended up looking at consulting and specifically was just very interested in biotech and pharma and that industry. And so when I got an offer to focus on that industry from Accenture, and in Boston, it's a hub, or back then and now. Back then it was a huge hub. The timing was just on point, just very lucky. So I ended up at Accenture for a couple of years, just doing that. And then I did what all consultants do when they still haven't figured out what they want to do with their life, which is go to business school. So from one area of building skill set, and I look back at that time in consulting, and it was just absolutely fundamental to what I do today, and to the rest of my journey, which was the skill set of being able to pull together a story, to pull together data and make it meaningful, to translate something that is very specific or deep in an industry perspective into something that most people can understand. And I think that's a lot of what consultants do.
Yeah.
As we take a look at the information, take a look at the data, pull together the analysis of why this is happening, and then drive that into a story that can really garner support. So that was consulting. Then went to do my MBA. And during my MBA, still couldn't figure out what I wanted to do. So ultimately,
did you love consulting, or were you like one of those people that ended up in the MBA and you're like, I'm a recovering consultant?
No, I loved consulting.
Okay, you did. Okay.
I love because first of all, I love the industry.
Yeah.
So working and learning about biopharma, and really taking a look at how large pharmas interact with biotechs, how they acquire pipeline, how that whole industry works was fascinating.
Yeah.
I mean, it's a difficult industry to understand, and it's good and bad at the same time, like a lot of industries.
Yeah.
But ultimately, it was one which I feel is important to understand for the rest of your life, to understand how medicines work, how products get FDA approval, what that means, how you can prescribe things off label. So you start to think about it, and you're like, this is actually a fundamental industry to understand for life purposes. Over and above, yes, it's a cool one to work in. So that was interesting. My MBA was really interesting. Still couldn't figure out what I wanted to do. So then was hired by a different consulting firm, and they sent me back to Dubai. And I say back to Dubai because this has been home since '95. And I, left a couple of years later to go to college. So coming back post MBA in 2005 was really interesting. And it wasn't
about it.
No, I was not excited about it. I think
what part of you that was like, I'm going back to my hometown?
No.
I
think we moved to Dubai as a family in '95.
Okay.
And I spent a few years here before going away to college. And Dubai in the late '90s was very different to Dubai today.
Yeah.
Right?
Yeah.
So when I left Dubai, it was very much leaving, without the intention to return.
Yeah.
Right. So then, 8 years later, you're coming back. And I guess my impression of it was how much had it really changed.
Yeah.
I had come back every holiday to see my family and to spend time, but to live here as an adult versus living here as a teenager would be very different. And had the city changed enough? Was there enough going on? So I had a lot of questions.
But that's what I mean, because a lot of people, when they think of their hometown, that they leave, they graduate high school. You graduated from Sweid, I think, like everyone else who's a Dubai kid.
We didn't have too many options back then.
Right.
It was Sweid, ASD, and Dubai College.
Right. But I think of that, and a lot of people think of it like, oh, I'm going back to my hometown. Sometimes there's this sense of like, am I going to go backwards?
Well, I think Dubai was interesting in 2005 because it was starting to boom.
Yeah.
Right. So there was definitely the acknowledgement that things are happening here.
Okay.
It became the fastest growing office for everyone in consulting, from McKinsey to Booz Allen to everyone at the time.
Consulting Central globally.
That was it. Right. So it wasn't like you're going backwards. It was just, for me, I'm going back to somewhere that I had never fully appreciated as a teenager, given I had been here for just a few years.
Yeah.
So I think that was very interesting to say, okay, I'm coming back to Dubai, and yet what does back mean when I hadn't lived here enough time to have, it's not home.
Right.
Right. So for me, it wasn't like going home. It was just going back. And my family was here, so I was grateful. And it's so much warmer than Boston. And I had been in Boston for a long time. Yeah. I was really happy to come back to sun and warmth. And I figured I'd do my 2 years with Booz Consulting and then, do something else.
Yeah.
But, I never made it through the 2 years. So I think I lasted one project and then went in to help my father with a company he was building just for a few weeks. But that turned into 8 years. And so
basically the consultant.
I think life had a much more interesting plan than the one that I could have come up with.
Yeah.
So those were my short consulting days.
Okay. And then you ended up in your father's business, family business, for 8 years.
Mm-hmm.
How was that?
It was amazing. So the first 3 years we were still private. We were a family-run company. Okay. It was an interior contracting company. So you take buildings that are just core and shell, and you do all the fit outs and FF&E.
Yeah.
And we were doing that for hotels and infrastructure. When I joined,
I should be doing it.
It was a great time in Dubai. And when I joined, we were in the Gulf and in Egypt. Okay. We were about 60 million revenue, 1,000 people. Did a lot of work on the governance and structuring. I know nothing about interiors or contracting, so it wasn't much more on the business side of things. But we were very lucky because the right time, right place.
Yeah.
We grew very quickly. By April 2008, we were a public company. So I IPO'd the business a few years later, 3 years after joining, and then kind of was in a public company rather than a family business for 5 years. So we're the biggest interior company in the world. We listed in London on the LSE. We listed on the Nasdaq Dubai. And we were in 22 markets by the time we IPO'd. So Singapore had become our biggest market. India was a big market. Really built the world's largest global interior company from Dubai. So that was the family business, the public company, and just an incredible journey. The type that strategy consultants advise you about.
Absolutely.
So it was really fun to be able to do it.
Yeah.
And to do it with my father was just really wonderful.
Because often that's the next step of a strategy consultant, right? Is to go on the client side.
Yes.
But then to go on the client side and have your father as your boss.
was really eye-opening.
Yeah.
I think that, the one thing I saw was how different he is in a business context than at home.
Interesting.
Right. So I think that there's a lot of impressions. I was like, I could never work with my dad. And it's like, yes, but in the office, your dad will be a very different dad.
Interesting. Yeah, that's a beautiful relationship, actually, a deepening of that.
It was wonderful. Yeah.
Amazing. So. And at the same time, you founded a Zen Yoga, which is one of the original gangster yoga studios of Dubai.
It's been a while.
Yeah. And it's definitely one that I've visited, and a lot of my yoga teacher friends in Dubai that have been here forever and ever started their careers at. Tell me a little bit about that.
So I came back to Dubai, ended up working with a family business, and really missed my yoga studios. And in Boston, I had just become an avid yogi. And even though I was consulting, would still find the time to practice. And it was really wonderful for me to find somewhere where I could center and ground. And that practice really kept, I think it kept me sane. It kept so I think it kept me healthy. And it was really fundamental, especially when you live such a high-speed life, to be able to just come to the mat and ground for an hour and a half, whatever it is, and kind of breathe and remember to center yourself. Yeah. And then you take that with you throughout your day and throughout your week, which is wonderful. But Dubai had no yoga studios. And so I thought one day on the weekend, I woke up at the time the weekend was Friday, Saturday. So I woke up one Friday morning and I thought, well, you know what? There's a wonderful... I'm going to create a yoga studio. Yes.
I love that.
I was like, how hard can it be? I'm very, very wrong. My famous last words. And there were no yoga teachers here. Not the ones qualified with that 200 and 500-hour teacher training. That just wasn't popular in the rest of the world yet. So I hired 2 teachers out of the U.S., asked them to come here, found a wonderful location. And, it used to be a gym. And the founder was leaving the UAE of that gym. So I took it over. I knew a wonderful interior fit-out company that I happened to work at the other 80 hours of the week.
Right.
So really just made it what I thought was a nice, peaceful, beautiful place for people to come and practice yoga, and brought 2 teachers in and thought, how hard can this be? And then it turned out to be incredibly difficult.
Yeah.
And that was really the beginning of my, I think, acknowledgement of how hard it is to be an entrepreneur.
Yeah. And I love that story because, so you've got the strategy consulting side, then you've gone on the client side, you've grown this massive business, you've IPO'd, and then you in your spare time, you decided you want to become this entrepreneur and have a brick and mortar business, which is really tough. And then how does that all lead? I mean, it's almost like a Cinderella story, right? Like, what are all the pieces here to make a good venture capital? How did you end up in
VC? So we scaled then. It did well. We sold it ultimately to a private equity firm, and largely because every time I'd walk in, it would be very stressful, and there's all these business problems, and it wasn't reducing stress the way it was intended. It was creating stress. But also we had 72 teachers. It had properly grown. And it needed a different set of management, a different set of eyes on it. That was exactly 10 years ago.
Wow.
So we sold it.
And were you actively looking for that exit?
No.
It came to you.
It came to me. I mean, I think most really good things that happen in life tend to fall out of the sky.
Yeah.
Right. And I think just to be open enough and to be curious enough to explore the opportunities, I think is key and fundamental. And whether it was in the family business, so that just happened because between my first 2 projects, my dad asked me if I could help for a couple of weeks, right? And then a couple of weeks turned into 8 years. And it would have been really easy for me to just say, no, I'm a strategy consultant. I like being on this side of things and I'm not willing to explore. But I think being open-minded enough to say, I'm willing to take a path I hadn't thought about taking. I'm curious enough to see what lies on this road. So I think that's key. And I think with Zen Yoga was the same thing. It was, well, let me start the yoga studio and see what happens, right? I'm curious enough to be a founder, an entrepreneur, although the intention was not to be an entrepreneur. I just really wanted my yoga lessons. So again, following from passion, right? Life lesson.
Yeah.
So I think all of that kind of culminated that by 2014, I had exited both companies and realized that in some ways being an entrepreneur and building from $0 to $1 million revenue was in some ways harder than running a $1 billion company.
Yeah.
And that to me was just very frustrating. And I realized both Zen Yoga and DEPA wouldn't have scaled without the right capital. So to think through then, if access to capital is fundamental to growth, what does the region look like? And I had started angel investing prior to that. And as those companies had scaled, the good ones needed more and more capital, right? There was no venture in the region. So I would introduce them to my friends around the world. The good ones would raise money, then they would leave.
Right.
And my thinking was, well, that's not very helpful to the ecosystem. So really started exploring, why is the ecosystem so small? Ended up joining another VC firm as a GP at Leap, and then quickly started realizing that within government, you can create so much impact. And getting government involvement and working with government to think through, how does Dubai go, not just tourism and some innovation, but really into innovation, was just such a privilege to work with the team over there, thinking through, how does Dubai do that? And how does the region do that? And how do we elevate our entrepreneurial ecosystem and our innovation ecosystem? And that was in 2016 and 2017.
Yeah.
That was a long time ago.
I'm curious, your time at MIT, that's a tech bubble in and of itself. I've spent some time in Silicon Valley. I've navigated a lot of GSBs coming to Dubai, and they're always surprised at how involved government is here.
Mm-hmm.
And, from my perspective, I look at it and go, well, somebody has to start it. Somebody has to have the capital to bring it on, the fund of funds. For MIT, a lot of it was MIT. And for Stanford, it was the same. It's not government, but it has to be a large enough institution with a huge endowment to fund these things. I'm curious what your thoughts are on this ecosystem that makes it so unique, not just Dubai, but Riyadh, across the whole region, really, being government-led. What makes it different, or is it different from...
I don't think it's different. I think even Europe, you take a look at, first-time funds in Europe over the last 15 years, 70% of the capital comes from some sort of endowment or government initiative, right? And in the U.S., you mentioned MIT, but MIT is largely funded by the U.S. government. You take a look at all of, historically, all of the initiatives that were offshoots from DARPA, right? And that's the U.S. government behind those initiatives that create a lot of the technology that we use today, right? So even the funding in the U.S., most VCs and private equity firms raise a disproportionate amount of their funds from endowments and pensions. So you stop and think about it. Governments are at the center of these ecosystems. It's just they do it differently. And so
several decades.
They have several decades ahead of us. So they can now fall behind and simply be a capital provider, not just an ecosystem enabler. Right? Whereas in the beginning, you would take a look, they were all ecosystem enablers.
Okay, beautiful. Okay, let's switch gears a little bit and get to the perfect pitch. To you, what encapsulates a perfect pitch? I know this is very subjective and it probably changes on depending what day of the week I get you on, but
yeah, not just what day of the week you get me on, but what founder you get in front of you. So a different founder, a perfect pitch looks different depending on the founder. Okay. So I think some founders would deliver a pitch in a way that's driven from passion and a problem they're solving and really, something they care about deeply, right? And some founders deliver it much more analytically, right? And that suits the different founders just as fine. It doesn't have to be one or the other. I think it can be both, right? So I think to the founders that are very passionate about the problem they're solving, I think the advice is always know your numbers, right? Because a lot of times they get so wrapped up in the problem they're solving and why they care about it so much and why it's so important that they often fall short in defining the size of the problem, how they would capture that, analytically how much that's going to cost for them, therefore how quickly are they going to grow, how much money are they going to need. So sometimes those founders are such wonderful storytellers and care so deeply that the analytical and the numerical part is weak. Yes.
Yeah. Okay.
And then for the other founders that are just highly analytical and, want to be an entrepreneur, it's not about wanting to solve a problem. It's like they want to be an entrepreneur. They want to create a company. They're builders, they're operators. They want to do that. Sometimes it's important to understand why they care about the problem so much. Because otherwise, you could always wonder, that if this industry stops being such a hot industry right now, are you going to just suddenly switch and sell me next year's fad word when that fad word exists? So there needs to be a bit more depth in terms of this is why this problem is the one that matters. And I'm just going to go at this for the next 10, 15 years, whatever it takes to solve this problem because it matters to me, rather than it's simply in the mind. You need to have a combination of mind and heart.
Yeah.
Right. And depending on where you lean naturally, you need to then beef up the other side.
Right. And I'm curious, in this region, do you find more of the latter than the former, of those that just want to be entrepreneurs?
I think you find both. I think this region has so much opportunity for people to build companies that it's hard to not want to be an entrepreneur.
Yeah.
Right. I think that it's important, though, to do something that matters to you.
Yeah. Yeah. Beautiful. And I mean, all of these things are important, but when it comes to product market fit and the idea or the founding team, if you had to rank, what comes first for you?
The founding team, always.
Everyone knows.
Well, you know what I think was such a wonderful takeaway from the unfortunate COVID pandemic was you could then quantifiably say companies that we backed for product market fit, but we weren't sure about the team. What happened when their market just suddenly got turned upside down? Versus companies that we backed the team, but didn't quite have product market fit, were they able to figure it out? Right. So you could take a look at success rates based on which one mattered. So historically, we have always said founder first. But then after COVID, you could say yes, because the companies that were founder first, those founders that we believed in, could easily change their business model to survive this. Whereas the ones where you back the business model, if the market dynamics changed, the founders didn't have what it took to survive.
Right. So backing the right team with the right skill sets, and they might have been, hopefully they were passionate about their problem, but they were more passionate about themselves and building something and figuring things out. And that helped them succeed.
That helped them succeed because you can change your business model.
Yeah, I want to jump a little bit to Egypt right now because I know you guys have been funding quite a lot there over the years, and they're going through a bit of a economic crisis. You know, I've been talking to a few VCs there, and yeah, they're facing exactly these challenges, and I'm sure a lot of your founders are facing these challenges. Basically, valuations because of the currency in free fall over the last 18 months. Your valuations of some of your companies are 50% of what they used to be, or every dollar coming in affords them half of what they could buy before. Are you also finding there that, what this question is coming from, I've been hearing that Egyptian founders in particular are quite passionate, and some of them are not willing to let go when it's time to let go. And so there's a little bit of a question here around, when do you know it's the right time to let go? Do you have these conversations with some of your founders to go, it's time to pivot, or it's time to shutter and start something new? How do you have that conversation?
I think that conversation is hard to have anywhere in the world.
Yeah.
I think, was it Term Sheet last week put out something about unicorpses?
Oh, yeah.
So again, it's really hard to have that conversation even in, once you have unicorn status and you've achieved that, what does that mean? Yeah. So the region is no different. I think for founders, the attachment to what they're building is always huge.
And it needs to be.
And it needs to be because otherwise the passion's not going to be there. I think in the region, when we talk to founders about letting go and moving on, it has to be numerical, right? In order to take the heart out of it and put the mind into it in a way. So in the region, I think the conversations need to be more numerical. So everyone's attached to whatever they start and they're passionate about it, and they put literally sweat, tears, and blood into building their companies. And then you're coming and you're saying, okay, time to move on. That is not a conversation that anyone's going to enjoy.
Yeah.
I think like all things in life, when there's a lot of passion and a heart, moving the conversation that it's a little bit more intellectual is always helpful. So when you take a look at venture-backed companies that exit, your average exit valuation globally is $170 million. It's not $1 billion. And I think that's always the crux of it, is if I've built something and it's worth $50 or $80 million and I can sell, Or do I hold on and try to push this to that $500 million mark in evaluation because I'm still estimating the valuations based on kind of 3 years ago or what we could achieve? So I think that bringing it back to a conversation that's globally, this is your average exit. You want to put a regional discount on that. You want to put a macro discount on that. A $50 million exit is not a failure. It's a massive success. That is
just the regional ticket size for an exit here.
I don't think we have the numbers on that yet. I think the region over the last year has seen a lot more exits than previously. Yeah. I think we're starting to see a lot more consolidation. So the numbers will come as the ecosystem matures. But I think that any M&A transaction could be considered a success because it means you've created something from nothing that has value enough that somebody wants to actually acquire it. And that is success. You've created something from nothing and it's worth something. Absolutely. So that is the mindset change that I think we're starting to see and we need to see more of, and then you can go create something else.
Are you seeing founders that are saying, no, I don't want to exit now. I see it being much bigger. Like they see an M&A exit as sort of less than? Because there's not really a huge IPO exit here. We've got a handful of cases.
I think most founders acknowledge that an M&A exit is probably their most likely outcome.
Yes. And is it not considered successful for most?
I think it is. I think it's the size and it's who you're exiting to. And it's, and I also think that in the region, and again, things are starting to change, but in the region, we haven't had enough second-time founders.
Yeah.
Especially not ones that are out there saying, hey, it's actually much easier the second time. A lot of the first-time founder challenges on who are you, why, do you know how to build a company? Can you attract the right team? Do you know how to sell? Those are no longer questions. If you've exited as a first-time founder, even a small exit, everyone will back you the second time. And we saw that, for example, with Tabby, when Hassam started Tabby, and we've seen that repeatedly at this point in time. And so for us to get to a point in an ecosystem where any exit that creates value for you and your shareholders or your investors and creates value for the acquiring party is something that is commendable. And it's not as complicated for that founder to go start their second company as it was their first one, thereby giving them the comfort and the confidence that they can. That's where the ecosystem's moving to. And I think it's moving there very quickly.
I love that. Yeah. Yeah, it's time. We keep saying it's in nascent stages, and it's like, how many years can we get away with saying that it's in nascent stages?
7 years, 8 years.
When it comes to founders, first-time founders coming to you for funding, and actually we can just broaden it to all founders, what is your biggest pet peeve right now?
I don't really have pet peeves. I think that each founder, it's important for the investor to try to see the world from the founder's point of view, right? So I think that the thing that is a little bit of a red flag might be too many hot words in there. So if you're building a blockchain-based AI that's going to do anything, you're probably trying to piggyback off trends rather than solve a real problem. And if you're piggybacking off trends, I have to wonder how much your heart is in solving the problem. And the reason that your heart needs to be in solving the problem is it's really hard to be an entrepreneur. And the days that you think you cannot make it, the only thing that keeps you going is the desire to solve the problem. And if you don't have that, then it's a lot less likely for you to keep going with that same drive as somebody who is, fixated on solving that same problem.
Okay. And so you're not seeing, a lot of founders coming to you without doing their research beforehand, or there's not anything that kind of irks you. Like give some of these guys watching this a little leg up and be like, smell nice.
And I hope they smell nice, not just for the pitch. But I think that, ultimately it's important for people to know the problem they're solving, to know their numbers around that problem, to understand their market. It's really hard to believe when someone says, I have no competition, right? So it's even if you don't have competition in exactly what you're doing, what are the substitutes being offered in the market that make what you're doing irrelevant? So it's really trying to get the founder to see things from the investor's point of view, right? Which is we see dozens of pitches a day, right? So why are you different? Why is what you're doing important? Why 5 years from now is what you're doing significant, right? And again, I think one of the challenges we face as founders that, want to build $1 billion company, and that's wonderful. But, we're signing up for a journey with you on solving a problem by building a product that people are going to buy, right? And those are the things we want to know. What is the product? What is the problem? How big is the problem? Who are the people that are going to buy it? Why would they buy it, right? And who's the team that's going to help you build this, right? And why would they buy yours, not someone else's, or continue doing things the way they do them right now? So those are the things that matter rather than what is the general market size of, $500 billion and how you're going to capture 0.02% of that. That is completely irrelevant. We believe in building things from the ground up.
Beautiful. Yeah. Okay. I'll take.
Was that helpful?
I'll take that. I'll take that advice. Let's talk a little bit about it's tumultuous times right now. Would you say that from sitting in a VC position, or would you say it's full of opportunity with everything that's going on in the market? Post-COVID, lots of funding, big lag in 2022 and 2023, particularly Dubai-based VCs, I would say, or at least for UAE startups, it's been, very dampened. It seems like a lot of investors are sort of sitting and waiting things out, and that obviously plays out in power dynamics as well, and perhaps evening the field, some might say, before where startups had a little bit more leverage to ask for what they wanted. What are you seeing in the market now? Where are we in January 2024?
So 2022, we had our record year of funding.
Yeah.
Right? And the rest of the world was already on their correction.
Mm-hmm.
So the region
lagging.
We're always lagging. The region always lags 6 to 12 months, maybe 18 months on the way down. The challenge is on the way up, we lag even longer. So those winters last a little bit longer for us. I think the power dynamic has shifted a little bit. I think that what we're seeing, though, is a little bit of a correction. So globally, you had much bigger hype in valuations, much bigger valuation inflation. And so you had this massive correction. In the region, we had some valuation inflation, but the region was never in a place where it had an abundance of capital. And so we didn't have this inflation the same way that the world did. And so my reckoning is that the correction will be adjusted to that size of that inflation of valuations. So it's not going to be as deep. The question is, if we have a longer dry spell in funding, who survives that, and do we have more companies that don't survive that as a proportion of our total?
That's interesting. Is speaking to investors outside the region and in the region, there is a bit of a stereotype maybe of more nascent emerging markets like this region, sort of inflating valuations because it's nascent, because the investors in the space are not as mature as, let's say, Silicon Valley. But you're saying that because the capital available in the region is so small, that there's a limitation to how much we can inflate those valuations, and so it's actually not that bad.
It's not that bad, and it's like any basic economics demand and supply curve. If the supply of capital is limited, right, at some point you can start pushing things, but ultimately you don't get the valuations you would where there's unlimited supply and founders can raise $10 million and then go on to raise another $10 million and just burn through that capital. Here, founders have to be very capital efficient. To the degree that, we're predominantly a Series A investor at Global Ventures, and a quarter of our portfolio is EBITDA positive. That's unheard of in the venture space globally. But it's a reflection of the fact that founders feel they have to get to break even in EBITDA early in their company's life cycle because of the lack of capital in the ecosystem, which then makes it that they're, raising with different dynamics.
Would you say that part of the reason why your portfolio is doing so well is also because you are focused on growth stage? So you're focused less on the seed stage and Series A plus, right? Does that make your startups, your portfolio companies, a little bit more easy to assess?
We assess them differently than seed stage. So then it becomes about market, product, clients, still largely about the founder, right, and the problem they're solving. But you can do a lot more diligence, and we do a lot more diligence. And I think that's also important for the region.
Okay. So, Noor, we could be talking all day about this, and I wish we could. But I have one final question for you. And in light of what's going on in the region, the VC winter, that's really, truly set in. And yeah, I also would love for you to comment on VCs sitting a little bit and waiting. Is that what Global Ventures is doing? What's your strategy going forwards? So that's part one of the question. And part two is, what advice do you have for founders who, are setting up their business and going, gosh, is this the right time? Is there money out there? Is there capital in the region for me to build my business? And what do I need to know? What do I need to do to make sure that I'm one of the few that get access to that capital?
So several things. One is, yes, we are actively deploying. We just made an investment last month into a fantastic company that called Malexi, that actually is blockchain-based, supply chain, agri-tech. Okay. So, it really checks the boxes for our thesis right now. And also love the founders, right? They're really eager to solve this specific problem and open to different ways to do it. So that's the answer in terms of we're always deploying. We never stop deploying. We're now deploying out of our third fund and hopefully get our fourth investment done by the end of this quarter into that fund. What we're looking at, and the advice I have to founders, is really be disruptive. So I think the region founders typically find that they have to be a little bit more emulative and less innovative when it comes to the business models or the problems they're solving.
Like mimicry.
Yes.
Copy paste.
And I think that has changed.
Okay.
And that is changing more and more, especially as the UAE becomes a real global talent hub, not just an ecosystem hub. We've always tried to model our portfolios in a way that half of the portfolio is emulative or mimicky, and half of the portfolio is really innovative. The innovative companies have the ability to scale globally. The emulative ones are wonderful. They're regional plays. They have a different risk-return profile. The way that we view the world, the emulative ones are the ones that are actually winning.
Are they your exits?
No. We've had already 6 exits out of our portfolio, mainly the regional plays, one of the global plays.
Okay.
So we're very lucky. We're able to come in, invest, work very closely with the founders. So we have a full value creation team. For us, we have 4 people that focus on how do we help founders through this journey from I have a little bit of revenue to I am substantially revenue generating. It's a 12 to 18 month 7-layer program that we've developed, that we've built for the last 5 years. We talk to each of our founders every 2 weeks to ensure they're on this growth journey until they stop needing us, as some do very quickly, some less quickly. But we work on everything from governance and processes to brand building and reputation, all the way through to recruiting. So for us, once we invest is when the work actually starts.
Absolutely.
And so as we work with founders through that, especially on the innovative side, we have now more than a dozen founders that have more revenues in the US and Europe than they do in the region. And when we started, they were only based in the region. Those are all real innovation, right? That's thinking outside the box, thinking specifically, this industry is really important to me. I'm really passionate about solving this problem. What is the best tech in the world right now, today, to solve this problem? Without taking a look at how has anyone else done it. Let me leave the how out of it. I'll do it my way. But what technology is available today? And today, we have certain industries at inflection points. So today, for us, anything touching supply chain tech is massively interesting. Because for us, that industry, 5 years from now, in 2029, is massively different to 5 years ago. Same with food security, right? So you start to think through different industries that in our part of the world and globally are facing disruption. You start to think about the world's best tech, and then you start to think about how you can solve a problem that you identify. And you put those together and you get real innovation. It doesn't have to be emulative or a copycat approach. So my advice to founders is find a problem you really care about solving. Find the best technology in the world that can be applied to solve it, and create a brand new solution, right? Rather than something that has been done and you're doing the same but different, right? And that's, interesting, but not highly compelling.
Mm-hmm. And say they do have all of that. What advice would you have for them in terms of approaching their research for fundraising and building out their cap table?
So I'll say two things here. The first is, we like to see companies off to revenue. So go build a product.
Don't see us unless you're making money.
No. Get to know us.
Right.
We like to get to know founders early and really work with them over the year and a half to see, are they doing what they said they were going to do? Are they building what they said? Did they pivot? Did they change their product because they knew how to listen to a potential client? And then when they have, let's say, $1 million in revenue, it's a lot easier for us to invest if we've known them for a year.
Right.
Rather than they show up that day and something's like, hi, who are you? Right. And then you have to get to know them over 6 months, and they've set themselves that much more slowly in terms of their fundraising. So the first bit is get out there, build a product, get some revenues. The second bit of advice that doesn't really help kind of venture capital is not all companies are VC backed or VC backable or VC desirable, right? As the founder.
Your yoga studio, for example.
Yes, exactly. My yoga studios, right? Although today, if I were building them, you with the hype and everything, one would think, well, let me try to build like the tech angle to this so I could go. No, that's not it. Right. So even a lot of tech companies can become profitable and grow. And some founders don't really think through what it means to take VC money. The commitments that the founder is making to a certain amount of growth. The fact that all VCs need to exit in 7 years. Right. So therefore, you have to achieve a certain amount of growth and scale, and you have a pressure cooker. Right.
It's not always 7 years. If you're about halfway through your vintage,
it can be 4 years.
That, hey, I've got to have returns on this in 3 or 4 years. Mm-hmm. Are these conversations you're having with startup founders, when they're sitting across the table?
We do.
This is what our expectation is of you.
We do.
Funding.
But I think a lot of founders don't really want to hear it.
Yeah.
So you can say it as the VC, and 7 years is a very long time in a founder's mind. I speak as a founder. I founded my firm, 6 years ago. So it's, I'm also like almost at the 7 year mark. I'm like, yeah, it feels like ages, but at the same time, it's not long enough to build what you would have wanted to build it. If I had an investor on day one, and today that investor was saying, okay, time for me to exit, I would say, wait, there's so much more to do. Right. So you really need to understand that when you take venture money, it comes with all of these expectations, which many founders in the hype and the buildup and the craze towards raising money and the desire to become sustainable and hire that extra CTO and that product person will very well say, I'm happy to do that. But then what we find is that once they do, many founders, 2 years later say, wait, this isn't what I signed up for.
Yeah.
And so I think it's important for the VCs to be very clear, but it's also important for founders to say, is there another way? Can I actually build this to profitability and then grow 50% year on year instead of 100% year on year, but I still own the company? I decide how fast we're growing. I decide which markets we're entering. And the answer might be no. The answer might be yes. But I think founders need to not simply assume that they should be backed by a VC or they should raise VC money, or that is any measure of success to have raised VC money.
I love that you brought that up. Yeah, I 100% agree with you. It's such a huge responsibility, and it's a very different company that you need to build when you have shareholders that you have to report to every week, and the governance structures that you put in place. Your business changes
absolutely
overnight.
So the founder is the only one who can answer the question of, do I know what this entails, and do I really want this? And I think that that's the first question that the founder should ask themselves. As the VC, by the time the founder is sitting in front of you, you should be able to make the assumption that those answers are yes. So you can briefly have those conversations. But by the time the founder is there, they've prepared the pitch deck. They've met many people who've raised money so that they can prepare how to present. They've taken the time, the effort. They're so far down that rabbit hole that it's unlikely that they ever come out of it.
Yeah.
The questions should be asked much, much earlier.
I love that. Noor, Thank you so much for your time today. It was such an intriguing conversation. And
Thank you for having me.
Be really valuable to a lot of people.
Thank you. Thank you for having me.
Yeah. Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to lucidityinsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.